China stocks are still taking a nice hit right now, especially after some recent news we got yesterday. On today's episode, we're gonna take a quick look at what's happening. We're also gonna take a look to see if there's any hidden gems hitting right now. Unfortunately, sometimes some bad apples can mess it up for everybody, but there always seems to be some form of play we can look at as long-term investments. So let's take a quick look at what happened. On Tuesday night, the State Council of China said the rules of the overseas listing system for domestic enterprises will be updated, while it will also tighten restrictions on cross-border data flows and security. So recently, what have we seen? We've seen a lot of cybersecurity reviews on some of the new IPOs, Chinese IPOs being listed here in the United States. So China's kind of taking a look at what's happening and making sure there's not a lot of data information being transferred in to other foreign hands. I'm not one to talk, but obviously it kind of makes sense of what they're trying to do. Unfortunately, here in the United States, American investors and investors here in the United States are taking a big hit, right? One of the most recent IPOs was DD. This one in the past 5 days is already down 27.95%. We have Kazun, another recent IPO that's down 18% in the past 5 days. So I mean, there have been talks. I want to say that whatever rules we have here for companies, international companies, to go into the American stock exchange need to be looked a little bit further and need to be updated faster, right? Because this is not something that's just happened now. It's something we've seen in the past few months, in the past few years, where for some of these international IPOs, unfortunately, is the American investors that are getting hit hard. So that's definitely something to take a look at. And I mean, I've been investing for multiple years, and there's always been like this negative sentiment of investing in Chinese stocks. But I want to say, right, it's definitely just a few apples that kind of mess it up for everybody else. So let me explain what I mean by that. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services the Fool offers. Through the Motley Fool Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you'd like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the Stock Advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. So if we take a look at the SPY, right, we're taking a look at the SPY 500 right now. In the past 5 years, the S&P 500 has returned about 104% to investors. Now let's take a quick look at what some of the Chinese ETF markets are kind of returning. And here, let me show you one thing I found pretty interesting is before COVID, before that drop in during the whole COVID correction, it took the S&P 500 4 years to pretty much gain 58.76% of those gains. In the matter of the past 12 months is where most of the gains have come up. So that's pretty crazy, right? It took 4 years to get to 58% gains. And in the last year or so, it has jumped all the way to 104%. So this is something to definitely keep in mind of. You hear a lot of bear talks right now saying that, hey, the market is moving way too fast. Me, I'm a long-term investor, so even if I believe the market is a bit overvalued, I'm not here trying to time the market, right? That's not what I'm here for. I'm a long-term bull, especially since I have time on my side. But let's take a quick look at an ETF, right? Invesco, Golden Dragon China ETF. We can take a look. In the past 5 years, this has given 92% to investors, right? That's not bad return. So you always hear, I want to say, a lot of negative terms that investing in Chinese stocks is bad, but there's a reason for it, right? I mean, there's a reason investors go into the Chinese market, right? In the past 5 years, right now, right, the S&P 500 has done better, but 92% isn't that bad, especially since at its peak in February of 2021, it was actually up 195%, And we can see from that peak, the stocks is down about 34-35%. Another thing I do want to say, right, the S&P 500 is more versatile with 500 different companies, all weighing smaller position size, where this kind of ETF, the one I'm looking, PGJ, the Invesco Golden Dragon China, is a more, I want to say, controlled or looked over, a more concentrated market compared to the S&P 500. So you would expect better returns, but still, right, there have been other ETFs like the KWEB, again 84% in the past 5 years, and from the peak it was up about 204%. Then you have another iShares MSCI China ETF. This one up 84%, and at its peak it was up 127%. So you can see why it's investors are looking to invest in international companies. And sometimes, right, the best thing might not be to look at individual companies, but tend to look at some of these ETFs instead. So if we take a look, right, the PGJ, which one I looked at, top 10 holdings make up about 61.57% of the holdings. You see companies like NEO, JD, Alibaba, Baidu, PDD. So some big players, some exciting companies, but again, you don't really risk your whole portfolio in smaller, in positions. You kind of diversified a little bit with a lot of different stocks in the Chinese market. The KWEB, this is a ETF that tracks only overseas listed Chinese shares of internet sector companies. So again, a lot of e-commerce, a lot of internet companies are in KWEB. So instead of investing maybe in just solely Alibaba, an investor can try to look at KWEB instead for another potential play. Then you have MCHI, right? This is market cap weighted index of investable Chinese shares. The fund stretches across all market sizes, and their overall market is, you can see, I want to say they have a lot of technology, 45% technology, 18% in finance, 11.69% in consumer cyclicals. So I personally, I have a few shares in different Chinese companies, but now that I'm looking at, hey, I believe maybe this market might be really taking quite a hit right now, maybe a Chinese ETF might be a way for me to kind of increase my overall exposure instead of buying individual stocks. But I hope you guys enjoyed today's episode. It's definitely good to see just how the overall market is doing, right? We always get this negative sense that investing in Chinese stocks is 100% bad, but we can see past investors have made money, and that's the reason they continue to invest there. So take care, guys. Have a good day, and see you next time.